Method of using moving averages in day trading. So here I'll discuss which moving average I use it, when I use it, how I use it. According to me, the most important, most powerful moving average is 8 and 20 on smaller time frame like 5 minutes. I use EMA, that is exponential moving average. I don't use simple moving average because exponential moving average is faster, so I prefer exponential moving average. I prefer 8 EMA for breakout trades, preferably mid to late afternoon. It helps in riding the winners most of the time. So that is why they say let your winners run and make profits big. You should let your winners run until candle closes above 8 EMA. What I mean by that, for example, you see that this is your CPR on your chart. Okay, this is your CPR, and you see that who are having problem with the trading to late afternoon. It helps in riding the winners most of the time. So that is why they say let your winners run and make profits big. You should let your winners run until candle closes above 8 EMA. What I mean by that, for example, you see that this is your CPR on your chart. Okay, this is your CPR, and you see that market was bearish, okay, above the CPR, and then it took the support at the CPR for some time, and finally breakout happened. So this is a CPR breakout. Many times what happens, we go and short here, right? And once market goes in direction, we get excited. But once we see it is coming up, we get panic, thinking that I should book my profit immediately. Otherwise, whatever the small profit I'm making, that will also go. So most of the time we go and book our profit here, only to see then market goes down, and finally by 3:30 market closes here. You booked your profit here. Had you not booked your profit early, you had that opportunity to book your profit here. Right? You booked profit too early, you made a small profit and you missed this kind of rally. That is what happens many times. We book profit too early, right? That is what 8 EMA can help you in that. 8 EMA works very well most of the time on breakout trades. Breakout trades like red candle breakout, green candle breakout, okay, CPR breakout, all these are breakout patterns. 8 EMA can work very well. Especially late afternoon, okay, mid to late afternoon it can work very well compared to opening session. What about the 20 EMA? 20 EMA I use it for following the trends on trending day. Trending day I already mentioned that trending day means market keeps going down, keeps going down, keeps going down, keeps going down like this. That is what trending day. Or market keeps going up, keeps going up, keeps going up. This is what market goes in a trend, in a single direction. It can be upside or downside. On such days, I use 20 EMA. So that is what 20 EMA helps me to take the best entry on trending day. I show you on the chart so that you will understand much better. Okay, 20 EMA is also powerful on 5 minutes time frame as well as larger time frame like daily chart. Even I have seen this is working well even on daily chart, daily time frame also. So now let us see on the chart. You can see on the 7th, which pattern you can see here, CPR breakout, right? Because it was taking support here above the CPR. Finally breakout happened in this candle. This is a CPR breakout. What you will do, you will go short here and you will keep your stop loss here above that CPR, and market goes down, you are happy that you are making profit. Suddenly one green candle comes. Then what happens? Suddenly you think that I should book my profit here. Otherwise, whatever the small profit I am making, I will lose it. You go and book your profit here. You ended with a small profit, but after that what happens? Market kept on going down. Finally 3:30 market closed here. So you miss this opportunity, right? You miss this big opportunity because you booked your profit too early. That is where 8 EMA can help you. So 8 EMA can help you many times. Whenever breakout happened, what you can do? You can plot 8 EMA. Just plot 8 EMA on your chart, and if breakout is very strong, most of the time price respect that 8 EMA and stays below it. You can see that till 3:30 not a single candle could break that 8 EMA. Not only that, look at the next day. You can see that every time it came near the 8 EMA, it got rejected. That means every time 8 EMA was respected. No candles could close above the 8 EMA. Right? So that is what 8 EMA is very powerful. Now if you ask me where to book profit, if you have taken this trade, square off your position at the market close, or if any candle breaks that 8 EMA and closes above it, that means done. That means you can book your profit. As long as candles are below 8 EMA, you can stay in that trade. That is what 8 EMA can work very well, especially when there is a breakout. You can see that there is a CPR breakout. Right? You can go and plot 8 EMA and look at this. Entire day price respected 8 EMA. Look at this. Till 3:30, no candles could break that 8 EMA. That is what 8 EMA can work very well on breakouts. For that, breakouts has to be very strong. If breakout is not strong, then it may not work. So remember that. So 8 EMA especially for breakout trades. What about the 20 EMA trades? 20 EMA I said on trending day. This is what trending day. Look at this. Candle opened with a big bearish candle, kept on going down entire day, and finally 3:30 market closed. That is what known as trending day. Market opened here, closed here. Opened at one end, closed at another end. That is what trending day. How to know trending day? One of the way could be narrow CPR. Look at this. CPR was very narrow, so it was very high likely that it was a trending day. First red candle, but what I said, RCR chances are high if CPR is broad or wider. If it is narrow, then there may not be any retracement. It may keep going like a trending day, and that is what happened. Kept on going up. So trending day I will not just short here just because market is going down. Trending day you should wait for some retracement, and the best retracement happens trending day most of the time near the sloping 20 MA. This is the sloping 20 MA. So when it comes back near the sloping 20 MA, if you see bearish candle, you can short. And most of the time it comes, take the resistance near the 20 MA, and again it goes in original direction. I will not short just because there is a 20 MA. I prefer if there is any pivot. Look at this. There is a daily pivot above that 20 MA. So my preference would be shorting somewhere here near that red candle, keeping stop loss above that 20 MA. So that is what trending day. Don't just chase. Don't just short. Let it have a retracement near the 20 MA. 20 MA very powerful whenever it is in the sloping mode. This is the sloping mode. This is the sloping mode. But look at this. This is the flat. So whenever 20 MA flat, it is not at all powerful. So you don't have to look at 20 MA. Okay. Whenever it is sloping, it is likely to work as a strong support or resistance. Look at this. In this chart, there was a narrow CPR, right? Trending day. Look at this here. Along with 20 MA, I can't see any pivots. So I will not be interested to short. Even though it's a trending day, sloping everything, because I said above 20 MA, if there is any resistance, I prefer, because pivot point is here, not above the 20 MA. But here you can see that every time it came near the 20 MA, it paused. But if you ask me which is the best place to go long, I will prefer this place. Why? Because along with 20 MA, there is a daily pivot also. So I'll go long on this candle. I'll keep stop loss below that green candle. So that is what 20 MA works very well whenever it is trending mode, when market is trending. So that's it about the moving average. Now we are going to the next one, using options in day trading. As I said, it's not an options webinar. You've seen that this was more about the chart patterns, price action, right, pivot point, CPR. So how to take the trades, entry, exit. So that is what I said in the beginning first session. It's not an options webinar, but I have a small topic where I'll discuss about the option. So that is what we'll be discussing here. Just brief about the option. First, let us discuss future is better or option is better. If you ask me, both have pros and cons. Options are cheaper, so many people trade in options because it is cheaper than futures. Mean brokerage is same in both future and option, but additional cost like STT, turnover tax, and all this very high when you trade in future. Brokerage is same, but other things are very expensive in future. But option also have a problem. That is keeping proper stop loss is a problem in option due to option Greeks like Vega, Theta, Delta and all this. This all are known as option Greeks. Option price depends on factors like option Greeks. Like Vega means volatility, Theta means time decay, Delta means how much your option price will move based on the underlying. So that is why if you want to trade in option, my advice is at least have a basic knowledge on this. Have a basic knowledge before you trade in options. If you don't know anything about the options, then better not to trade in option. That is one thing. Problem with the option is the keeping a proper stop loss is a problem. Future that problem is not there, but in option that problem happens many times. Because option there are so many options at the money, in the money, out of the money, same week expiry, next week expiry, monthly expiry, right? And every options have different strike price, and you will get confused which option to choose, and you can't keep same stop loss for every options, right? So that is the issue. As I said earlier, I said you have to take the trade based on the spot chart, but you have to buy or sell only in the future or option, because in Nifty and Bank Nifty in indices you can't trade directly in underlying. You can trade only future and option. Suppose you want to trade in stocks, HDFC Bank, Reliance, whatever it is, you can trade in future, you can trade in option, you can directly trade in cash, right? But in Nifty, Bank Nifty, you can't trade directly in the spot. Only you can trade in future and option. That is why you have to choose either future or options. That is what sometimes keeping a proper stop loss is a problem in options. But still I can tell you that how you can keep your stop loss in options. In my ebook, I have made a write-up how you can trade in future and option looking at the spot chart. In what option, how much stop loss you can keep, basis on what, future, how much stop loss you can keep. In that you will see how you can trade in future and option. So this is the topic. I'll just give you brief about option buying or option selling, which is good, everything. If you ask me which is better, option buying or option selling, there is always a debate goes on between option buyers and sellers, right? Option buyers say option buying better, option sellers says option selling better. If you ask me my opinion, I will go with this. I also say option selling better than option buying most of the time. Not all the time, most of the time. Because two ways to earn money in option selling compared to only one way in option buying. What I mean by that, let me just brief it. Assume that next week you are very bullish in Nifty. Okay, next week you think that Nifty is going to go up. So what you will do, you will buy a call option, right? You will buy a call option because next week you are bullish in Nifty. You know that market can go only three directions: uptrend, downtrend, or sideways. There is no fourth way, only three ways, right? So suppose next week you buy a call option and assume that Nifty starts going up. What happens? You make profit, right? You make a profit here because it's going up. So assume that next week you bought a call option but Nifty is going down. What happens? You make a loss, right? Here you make loss because your direction is wrong. Next week assume that you are not right, neither you are wrong. That means neither market is going up or going down. Market is staying sideways. So what happens? Here also you will lose money. So that means you will make profit being an option buyer only if direction is right. If your direction is wrong, you will lose money. If your direction is not right or not wrong, that means sideways market, here also you lose money. So that means only one way you make money as an option buyer, only when your direction is right. Now what about the option seller? I prefer option selling. Assume that next week I feel that market Nifty looks bullish, so I will not buy call option. I'll sell put option. Okay, option sellers will not buy, they will sell put option when they're bullish. For me also same, like market can go up next week or market can go down next week or market can stay sideways. Only three things can happen in the market. So assume that next week market goes up, I make profit because my direction is right. Assume that next week market is going down, I make loss. So same thing like option buyer, option sellers also lose money when direction is totally wrong. This is where option seller have a edge. That means next week market doesn't go up, neither goes down, it stays sideways. Option sellers make profit. So that means option sellers make profit two ways and only one way they lose. Okay, that is why option selling have an edge, because two ways to make money in option selling, option buying only one way. Means even market stays sideways, option sellers make money. As I said earlier, out of 22 trading days, most of the time market stays in sideways, right? That's why I said you should know how to trade the sideways market, because most of the time market stays sideways. 70% of the time market stays sideways. They say only 30% of the time market goes in a trend. So who makes profit whenever market stays sideways? Obviously option seller. So that is why I said I prefer option selling rather than option buying. Why it happens? Because of the theta effect. Okay, there is something called theta, time decay, especially in out of the money option I'm talking about. Okay, if you sold out of the money option and market stays sideways, you can make profit by selling option because of the theta, time decay effect. Always it favors option sellers. So that is why option seller have an edge or option buying in trading. Having said that, I'm not saying that option buying is very bad, option buying is bad or something like that. Option buying also sometimes can work. You should buy option when you are very bullish or bearish, like breakout kind of trades, right? Where you can expect a huge move, that time option buying can work very well. When you are slightly bullish, slightly bearish or expecting market to stay sideways, option selling would be better. For selling option, I prefer at the money or slightly out of the money option for theta advantage. And buying option at the money is better on before expiry, like Friday, Monday, Tuesday, and near expiry or expiry days, better to buy slightly in the money option, because premium erosion in out of the money will be very faster. So that is why if you are buying option, better to go slightly in the money option near to expiry. Okay, but same time if you are selling option, then go for slightly out of the money, or you can sell at the money put option if you are expecting market to go up, or if you are expecting market to go down, you can sell at the money call option, because at the money option gives you better premium, higher premium. Out of the money less premium. Buying out of the money option near to expiry can be loser's game, but sometimes can be jackpot also. You know what is the jackpot? Jackpot is like a lottery ticket. Okay, lottery ticket, you know that you pay 100 rupees and if you are lucky, you can win even 10 lakh rupees. That is what the lottery ticket, right? Jackpot. You can make huge money with a small investment. So option buying also sometimes can give you huge profit. Most of the time you will lose money, but sometimes you can hit the jackpot also. Very rarely, but option buying works best only whenever you are expecting a huge move on one side. That is what I said. Option buying is better whenever you are expecting a huge move. Then only better to buy option. Otherwise, option selling is better. Let me show you one chart. Look at this Bank Nifty 30,500 call option on September 26, 2019. You know, it was trading around 5 rupees. Okay, it was trading around 5 rupees. You know, within 15 minutes, this is a 5 minutes time frame. Within 15 minutes, you know where it went? 630 rupees. From 5 rupees option went to 630 rupees. So that means 5 rupees option can go more than 100 times, that also within 15 minutes. If you invested 5,000 rupees by buying 5 rupees call option, just imagine how much profit you would have made within 15 minutes. That is what I said, it's like a jackpot. But remember, option price will not go just like that. Okay, it will not go up or down just like that. For that, underlying has to move. What is the underlying here? Bank Nifty is the underlying, right? So if Bank Nifty makes a big move, then your option price also can go like this. So now let us see what actually happened on September 26th in underlying, that is the Bank Nifty chart. You can see here September 26th, market opened with a bullish candle, it kept on going up, and this is where your option went to 630 rupees from 5 rupees, because your bank nifty went for almost 700 points. You can see that almost 700 points within 15 minutes. So that is how your option also suddenly jumped from 5 rupees to almost 630 rupees. So that is what I said. If you are buying an option, it can be jackpot. You can make a big money. For that, underlying also has to move like this. So to learn more about the option, to gain the option knowledge, best platform is go to Google, type Zerodha Versity. Okay, Zerodha Versity is one of the best platform where you can learn everything about the option. And also you can go to YouTube and you can type Sensible. This is also another platform where they have many YouTube videos on options, and you can learn options from here also. So that is what I said, options, you need knowledge. Don't trade an option until you know the basics. This is important note to everybody who is planning to become an option seller. Remember, option selling is very risky, okay? Because loss can be unlimited in option selling. In option buying, loss is only limited to whatever premium you paid. You can't lose more than whatever the premium you paid. But option selling is not like that. Loss can be unlimited in option selling. So option selling is only for professionals who have options knowledge and knows how to manage risk. So have some knowledge before you want to trade in options. Don't just get into option without knowledge, especially option selling. Or even if you are doing option selling, either do the hedging, option selling, or at least keep stop loss, because option selling can be very risky compared to option buying. So with that, we are done with the entire topics of the second session. Third and fourth session will be risk management and trading psychology. Okay, now we are coming to the third session, that is risk management and position sizing. One of the famous book ever written on trading is called Market Wizards, written by Jack Schwazer, and this is known as one of the very famous book ever written on trading. This book contains interviews with top traders of the world. Okay, some of the successful traders in the world, they have given their interviews in the books. In these books, they have given their interviews and they have shared their strategies, how they have become a successful trader, what is the method they use, everything they have shared it in this book. You will see that after finishing this book, all successful traders have different strategies, different methods. Still they are very successful. So that means there is no magic strategies or magic indicator that every successful trader using that indicator or that strategies, that's why he is successful. Nothing like that. It is also about risk management and having discipline in trading. That is what makes one successful trader. This book is like an eye opener, and you will realize that you can have any good strategy, but you should also have good risk management skills, and you need to be disciplined in trading to become successful trader. So risk management is equally important as having a winning strategy. Risk management is probably holy grail when it comes to trading. Why they say it's a holy grail? Because you can become a profitable trader with a win rate of 50%, even 40%, even 40%, 50% also, you can become a successful trader. That means you don't need a strategy like 90%, 95%, 99% win rate. You don't even need 80%, 70% kind of accuracy, kind of win rate. Even 40%, 50% also can make you profitable trader. So that is why risk reward is very important when it comes to trading. Look at this example, look at this slide. If you take only 20 trades in a month, on an average maybe one trade per day, you have a 50% win rate. That means 10 times you win, 10 times your stop loss hits. How much return you can generate per month? 10% return. How it is possible? That is possible if you follow this. That is what I have been saying from the beginning of this session, that 50% win rate also can make you profitable trader. You don't need 80, 90, 99% win rate. provided you follow this. Okay, so that means if you follow 1:2 risk reward, you can generate 10% return per month with 50% win rate and only taking 20 trades per month. Let me show you another example. Here you will take only 20 trades and you have only 40% win rate, not even 50%. You have just 40% win rate. That means 8 times you make profit, 12 times your stop losses. Can you see at the end of the month? Still you are making profit. Still you are making a small profit of 4%. That is also with just 40% win rate. How it is possible with 40% win rate still you can make profit? Because you are following risk reward. Right? Whenever you lose only 1%. Whenever you win 2%. So how much profit you make? 16% by 8 wins. By 12 losses, your loss is 12%. Why? Because you lose only 1% whenever you lose. That is how you make 4% return per month. Just by 1:2 risk reward. Suppose you have 1:3 risk reward, then your return will be much higher. Okay, so I shown you only 1:2 here. So higher the risk reward, your win rate also can be smaller and still you can make profit. 40% win rate also you can make profit in trading. You don't have to run behind 90%, 95%, 99% accuracy and all this. Risk reward is something every trader should follow, and very likely you will become a profitable trader if you follow this risk reward in your trading. Now let us discuss about the position sizing. What is position sizing? Position sizing, I told you that it will let you know how many shares or lots you have to buy before taking a trade. Right? So I said trading is what important first. First is you have to survive. Focus on survival first. Okay? If you survive, then only there is a chances that you may become a successful and profitable trader. Right? How to survive? For that, you have to know the position size. Position sizing will tell you how many lots of shares you need to take before taking a trade. For calculating position sizing, two things important. First, you have to calculate your trading capital. Second, determine your risk. My advice is never risk more than 1% in a single trade. Always ensure that your risk is only 1% in a single trade. That means if your capital is 2 lakh, how much is 1%? 2000 rupees. So that means you should risk maximum only 2000 every time you take the trade. But how to do it? For that, there is a formula. This is the formula. Percentage of risk per trade into capital divided by risk per trade. Suppose you want to buy Bank Nifty future at 30,200. You want to go long, okay? And you want to buy Bank Nifty future. You entered at 30,200 and you kept your stop loss, that is 40 points stop loss. And your take profit is, target is 80 points, right? 30,200 is your entry price, 30,160 is your stop loss, 30,280 is your target, that is 1:2 risk reward. Now you have to apply that formula. What is that percentage of risk per trade? I said 1%. What is your capital? I said 2 lakh rupees. What is the risk per trade? Risk per trade means stop loss 40 points. What is 1% of 2 lakh? 2000 rupees. How much is the stop loss? 40 points. So how much 2000 divided by 40? 50 units. How many units in a lot? One lot of Bank Nifty? 25. So that means you should trade only 2 lots of Bank Nifty if your stop loss is 40 points. So if your capital is 2 lakh, stop loss is 40 points, you are supposed to trade only 2 lots, not more than that. If you are trading in some shares, only 50 units. Okay? Why it is important? Important is, even though your stop loss hits, how much loss you will make? 1000 rupees per lot, you are trading with 2 lots, 2000 rupees you will lose if your stop loss hits. And how much is your risk? I said 1% of your capital. 2 lakh is your capital. So you will lose only 2000 rupees. So that is what the beauty of position sizing. So that is why position sizing is very important. It will ensure that you are within your limit. Your risk is always controlled. So if you want to control your risk, always ensure that you do the position sizing. And my advice is never risk more than 1% of your capital. So this is what position sizing. and this is the formula which you should follow it. So this is what position sizing is all about. Now let us look at the 5 rules of risk management. What are the rules you have to follow to become a good trader? First is 1% rule. 1% rule means you should never risk more than 1% of your capital in each. How to do that? I just shown you the position sizing, right? So if you know the position sizing, you can ensure that you will never lose more than 1% of your capital. Second is always have stop loss in each and every trade. It should be in the system, not a mental stop loss. Okay, so my advice is always stop loss should be in the system. It should never be a mental stop loss, and that is 1% of your capital. Never average to your losing position. Never add to your losing position hoping that it will turn around. That is what many people do that mistake. Suppose they bought a call option at 200, they think that market will go up, but market is coming down. And what they do, they keep adding the position. As market is coming down, they'll keep adding the position. They'll keep adding it. Why they will keep adding it? Thinking that when it bounces, then I'll make profit. But sometimes you will see that bounce will not happen. Market keeps going down and they end up with a big loss because they are adding the position, means their lot size becoming bigger and bigger. So that is why never average to your losing position. Once you decided this is my stop loss, that's it. If market reverses, your stop loss hits, take your stop loss and exit the trade. Averaging doesn't work in day trading because you have to square off your position same day in day trading, right? By 3:15 you have to square off your position, otherwise your broker will square off. So that's why averaging doesn't work in trading. This is one thing very, very important. Have a daily limit loss of maximum 2% of your total capital. That is what the difference you'll see novice trader with a professional trader. You know what? Novice trader always he thinks, dreams about the profit only, but professional traders, they focus more on risk. Their focus is this. They focus more on this, but novice traders focus too much on profit. He ignores the risk. So let me give you an example. If there is a professional trader, he has only 2 lakh capital, and before market opens, he will decide what is my daily limit loss. How much is maximum I am ready to lose. Suppose 2 lakh rupees capital, he says maximum 2% is my risk today. That is 4,000 rupees, right? Look at this. He is not thinking about profit. He is thinking about how much I am ready to risk. Suppose he takes first trade and stop loss hit. Assume that 2,000 rupees gone, right? Assume that he takes another trade after some time. That also his stop loss hits. He lose another 2,000. So total how much he lose? He lose 4,000 rupees. What is his daily limit loss? 2% of his capital. What he does? He'll shut down his system. That's it. He will not keep watching the chart, how to recover the loss, everything. He decides my daily limit loss hit, I'm done, and he shut down his system. That is what he does, and he comes back next day. That is what discipline is. But what novice traders does, suppose a novice trader have a 2 lakh rupees capital, assume that first trade hits stop loss, he'll get angry. Suppose another trade hits stop loss, he'll get double angry. Then he will not stop there. What comes to his mind? He thinks that, oh, I lost 4,000 rupees since morning. I have to recover my loss. I have to recover my loss before market closes. He keeps fighting with the market to recover the loss, only to end up with a big loss. Because he keeps taking revenge trades. Earlier he was losing only 4,000. It may happen that he end up losing 20,000. Almost 10% of capital gone in a single day. Why it happens? Because of the revenge trading. Try to recover the loss because there is no plan for the risk. He is only thinking about profit. When market goes against his direction, he doesn't have any plan, end up with a huge loss. So that is why always have a daily limit loss. It can be 1% of your capital, 2% or maximum 3%. My advice is don't go beyond 3. 2 is better. Finally, and have a strict risk reward of 1:2 in every trade. More than win rate, focus on risk reward. If risk reward is 1:2 and your win rate is 50%, you are guaranteed to be a profitable trader. Okay, so that is what important in trading. Okay, now we are coming to the trading journal. Why it is important? It's very important because you should treat trading like a business, not like a gambling. Right? Like other business, how you maintain a record keeping book where you will keep all your records. In trading also you should treat like a serious business where you'll keep records of all your trades. Every day you have to enter your trades and you have to take it very seriously. Every week you have to do the review about your trades. Every month you have to do the review. What I have done last month, last week, how many trades I have taken, am I following the risk reward, am I following the rules, everything will be like a mirror for you. And that is what the difference between a professional trader and a novice trader. And remember, once you start following the trading journal, it will make you very systematic trader, and once started, you will enjoy doing it. Okay, that is what important. That trading journal, every trader who wants to become a professional, they need to have trading journal. Okay, this is the trading journal format which you will receive it along with the course materials. Okay, along with the course materials, you will receive this trading journal format also. If you have not received or something, you can send me an email also so I can share it with you. And you should start following it regularly. Every day you have to enter your trades, and that helps you in becoming disciplined trader. Finally, we are coming to the last session, fourth session, that is trading psychology. If you want to become a successful trader, you need three things. You need to have a good strategy, you need to have good risk management skills, and you need to be good in trading psychology. Again, if you ask me, out of these three, which is most important? This is what most important. Right. Trading psychology is something very important, even compared to even strategy and risk management. 50% of your success depends on how good you are in trading psychology, and remaining 50% on strategy and risk management. Why it is trading psychology? They say your 50% depends on trading psychology, because strategy you can learn it, risk management you can learn it, but trading psychology, it is not something that somebody can teach you. It all depends on you, your willpower, your mind. Right? It all depends on you, how well you can control your mind, control your emotion. Somebody can't control your mind or control your emotion, only you can control it. That is why trading psychology is very, very important. Your success, 50% of success depends on how well you control your emotions or your mind. Successful traders are not successful because of some magic indicator, but because of right mindset and discipline. Remember this. That means there is no magic indicator or a magic strategy, but you need to have good strategy, but same time you should be having right mindset and discipline. Many new traders constantly search for holy grail strategy that can give winning trades all the time, but does it exist? No. Okay, there is no holy grail strategy, so don't have to run behind holy grail strategy. It's more about having a good strategy, following the risk management, and having the good trading psychology. Now let me tell you what all you can do, how you can control emotion during trading. First thing is that you have to have strict discipline. Trade according to entry exit rule, never on your emotion. Don't trade with your emotion, follow the rules, entry exit rule. Focus on following the rule, not on outcome of the trade. You should avoid revenge trading. Once stop loss hits, you are out. Don't keep fighting with the market. FOMO means fear of missing out. If you miss one opportunity, another one will come. Okay, market will be there, right? Monday to Friday market is open. There is always a tomorrow. So that's why you don't have to worry about missing the opportunity. If you miss one opportunity today, tomorrow you may get another opportunity, right? So that is why don't have FOMO. Over trading. Have a strict rule of around 1 to 2 trades per day. Like any other business, the more you work, more money you can make, right? You can be more successful, the more harder, the more you work. But in trading, it is not like that. In live market, you don't have to work very hard. You should work very hard in trading also, like back testing and all these other things. But in the live market, You don't have to work very hard, like taking too many trades. You don't have to do over trading. In trading, lesser the better. That means have a strict rule of one or two trades per day or maximum three. So over trading, never do it. Always have a rule. When you do the over trading, you start taking random trades, impulsive trades. When you have a rule that I'll take only one or two trades per day, then you will wait for the right setup and right patterns. So that's why I said in trading, it is not that more trades you take, it doesn't mean that you are going to make more profit. When you take less trades, you wait for high probability patterns. Remind yourself, trading is a probability. Any strategy can have a losing streak or a winning streak. So don't get depressed when you are going through losing streak. Don't get excited when you are going through winning streak, because it's a probability. You may go through both. You don't need to be right each and every time. On the long run, you need to be right only 50% of the time to stay profitable, right? If you take 100 trades over the long run, you should be comfortable even 50 trades hit stop loss, because 50% win rate also enough to become a profitable trader, provided you follow risk reward. Have confidence in your strategy. You should stick to one strategy and master it. Don't jump from one strategy to another strategy. This is something very common with a new trader. When he starts trading and he applies some strategy, if that strategy is working and giving him profit, he thinks that strategy is the best in the world. And the moment that strategy fails, hits his stop loss, he thinks that that strategy doesn't work. Then again he thinks that he has to learn new strategy, and he learns new strategy and again he applies it. So whenever any strategy hits the stop loss, he thinks that that strategy doesn't work and he has to learn a new strategy. So he will be only jumping from strategy to strategy. He will not master anything. So one should understand that there is no holy grail strategy. Any strategy can fail and hit stop loss. No strategy which works all the time. All strategies are probability. So what you should do? You should stick to one strategy and master it. Have patience, not FOMO. Wait patiently for right setup. Only trade when there is a high probability setup or pattern. When you are in doubt, do nothing. When you are looking at a chart, if you are trading in Nifty, and if you want to go and take a long trade, Nifty is looking very bullish, but same time you see that Bank Nifty looking very bearish. Both are showing different setup. One is bullish, another is bearish, and you are confused. What should I do? Should I go long in Nifty or should I short Bank Nifty? So when you get that kind of confusion, when you are confused, when you are in doubt, the best thing to do is do nothing. Don't force a trade. Don't have a compulsion to trade each and every day. Good trader is the one who also knows when not to trade. So that means good trader is not the one who only knows when to trade. He should also know when not to trade. Day trader doesn't mean you have to be constantly trading the entire day, taking 10-15 trades per day. So as I said earlier, lesser the better. In trading, you don't have to take too many trades. If you take 10-15 trades in a day, doesn't mean that you are going to become a profitable trader. Lesser the better in trading, and always have that patience to wait for the right setup to take the high probability trades. Self-analysis. Do a self-analysis on your personality. Ask yourself, what's your weakness? Are you an impatient person? Are you a short-tempered person? Are you egoistic person? Or are you a revengeful person? If answer is yes to any one of them, you should work on it, because your personality reflects in your trading. Suppose you are a person, by nature you are an impatient person, that means in trading you will be having that FOMO problem. That means since you are a person who lacks patience, in trading also you do same thing. So you will not wait for the right setup, immediately you jump into trades without even having right setup, because you don't have patience, because you are impatient person, so you do same thing in trading. Suppose you are a revengeful person by nature, in trading also you will do same thing. you will take revengeful trades because you are a revengeful person by nature. If you are an egoistic person, then you will not keep your stop loss or you will keep averaging in trades. Because if your stop loss hits, your ego gets hurt and you don't want to be wrong. You want to prove to the market that you are right, market is wrong. And you keep averaging it whenever trade goes against your direction and only you end up with a big loss if you do like this. So that is why if you are an egoistic person, then you will have ego while trading also and you don't like to take your stop loss because it hurts your ego. If you are a short tempered person, you will keep fighting with the market whenever your stop loss hits because you are angry that market has taken your stop loss and you'll keep fighting with the market to recover that loss. So that is what happens when you're having all this weakness as a person. So that is why if answer is yes to any one of them, work on it because your personality reflects in your trading. That's why to become a good trader, you should have a cool and calm mind when you are trading. So that is why you should work on your personality if you have any of this weakness. So this book is specially for people who are having problem with the trading psychology. This book is written by Mark Douglas about how to control emotion, how to control the mind, how successful traders they control their emotion, what you should do, how you should think like a successful trader. That all very nicely explained by Mark Douglas in this book. So this book you can purchase it from Amazon if you think that you want to work on your trading psychology, because as I said, 50% of success depends on trading psychology, how well you control your emotion during live market. With that, we have come to the end of this course on day trading with pivot points and price action. With that, I wish you very good luck in your trading career.